Welcome, everyone, to this explainer. I am absolutely thrilled you're here today because we are diving headfirst into the Tax ENews May 26 update. We're going to take a bit of a journey together. We'll start with some incredibly urgent compliance rules, things you absolutely must follow to protect your wallet, and then we're going to pivot into some truly bizarre, real-world courtroom tax battles that you honestly won't believe until you hear the evidence. Seriously, if you've ever wondered how a marshmallow, or a private trout stream for that matter, could end up in a legal tribunal over tax law, well, you are in exactly the right place. Let's get into it.
So here's our roadmap for today. First up, welcome to Making Tax Digital. Second, corporate loans and CIS updates. Third, the mega marshmallow VAT loophole. Fourth, capital allowance limits explained. And finally, the mixed-use property myth.
All right, Section 1, welcome to Making Tax Digital. Look, there is a severe sense of urgency attached to these dates. If you're a self-employed individual or a landlord, and your turnover was above £50,000 back in the 2024 to 2025 tax year, well, you were mandated into this regime starting April 6, 2026. You're already in it. And that means your very first quarterly update deadline is rushing towards you on August 7, 2026. But what if you fall slightly below that bracket? Well, if your qualifying income, and by that I mean your turnover before any expenses are deducted, was over £30,000 in the 2025 to 2026 tax year, your start date is April 6, 2027. So that net is widening, and it's happening very soon. We're talking about a fundamental shift here. The old system was all about looking backward, right? You did your annual record keeping and reporting long after the year actually ended. But under the new MTD system, it's a whole new ballgame. We're now living in a world of in-year digital record keeping. You literally have to send updates to HMRC every single quarter using compatible software. Now, I want to be super clear about this. This doesn't mean you're suddenly paying your tax 4 times a year. No. What it does mean is you're reporting much more regularly. So the absolute crucial takeaway is that you need to take action right now. If you haven't already, you've got to choose the right software and really understand these reporting requirements so you can stay in complete control of your tax affairs. Moving right along, Section 2, Corporate Loans and CIS Updates. Brace yourselves for this one. We're looking at a massive new Section 455 corporation tax charge rate of 35.75%. Let me break that down. When a close company makes a loan to a participator, which, usually just means a shareholder, and it isn't repaid within the same accounting period, this charge kicks in. For any loans advanced on or after April 6, 2026, the rate jumped from 33.75% straight up to this new 35.75%. Now, there is a lifeline. If that loan is repaid, released, or written off within 9 months of the end of the accounting period, you can actually claim relief from the charge in your corporation tax return. But, and this is a big but, here's the catch. You cannot claim relief for anticipated future repayments. You have to actually repay it before the return is submitted. If you repay it after the fact, well, then you're going to have to go through the whole hassle of submitting an amended return. And the strictness? It doesn't stop there. If you operate within the Construction Industry Scheme, or CIS, the rules have tightened significantly. As of April 2026, the law requires contractors to file a CIS return every single month. Even if you haven't used a subcontractor at all, you still have to file a nil return, or an inactivity request. So the nil filing requirement is back, and it's brought along a pretty brutal late filing penalty regime. Miss it, and boom, you're hit with a £100 fixed penalty. 2 months late, that's another £200. Hit 6 and 12 months, and you're facing tax-geared penalties of at least £300 or 5% of the liability. And worst of all, if HMRC finds you connected to a fraudulent payment, you can face an immediate penalty of up to 30%, and they can instantly revoke your gross payment status. Reapplying for that status used to take 1 year, now it takes 5 years. The mounting consequences here are absolutely huge.
Okay, time to shift gears a bit. Section 3, the mega marshmallow VAT loophole.
So, that legislation in the UK generally zero rates food, but it explicitly excludes confectionery, meaning confectionery gets taxed. Legally, confectionery is defined as any item of sweetened prepared food which is normally eaten with the fingers. So the first-tier tribunal actually had to sit down and answer a totally bizarre question sent down by the Court of Appeal. Does a 5-centimeter mega marshmallow fit this description?
And honestly, this brilliantly illustrates just how absurd tax law can get. Standard-size marshmallows are subject to the standard 20% VAT rate because they are, well, eaten with the fingers. Makes sense, right? But the tribunal ruled that mega marshmallows, specifically because of their massive 5-centimeter size, are primarily intended for roasting over fires to make s'mores. Therefore, they're more frequently eaten by non-finger methods. Because of that wild logic, they completely escaped the definition of confectionery and are 0 rated for VAT. Oh, and those mini marshmallows, if they're sold as a baking ingredient, they're also 0 rated. I mean, we are talking about the exact same sugary substance getting 3 entirely different tax treatments depending purely on its size and how it's consumed. The real takeaway here, VAT is incredibly complicated. If you're selling physical products, don't just guess your tax rate based on common sense. Get professional advice. All right, back to the heavy hitters. Section 4, Capital Allowance Limits Explained.
So let's talk about Ørsted. They spent significant amounts of money on environmental surveys, seabed studies, and technical investigations well before any of their offshore wind turbines were actually built. They argued, quite naturally, that these costs were totally essential to creating the assets and should therefore attract tax relief as capital allowances. But the Supreme Court actually sided with HMRC, and it all came down to a very specific statutory phrase, on the provision of plant or machinery. The judges ruled that this exact wording requires a close, direct link to the physical asset itself. Yes, surveying the seabed was absolutely necessary to figure out if and how to build those wind farms, but legally speaking, that's just preparatory work. It put them in a position to build, sure, but it wasn't the actual provision of the plant itself.
So what does this actually mean for you? Well, here's the actionable takeaway, and it applies way beyond just offshore wind farms. Many businesses incur huge costs before buying or building long-term assets. Think about things like feasibility studies, professional fees, or regulatory assessments. After this ruling, it's highly unlikely those early costs will qualify for capital allowances, unless they are tightly bound to the actual installation or acquisition. You absolutely must map your costs carefully as they arise. You've got to separate the early exploratory spending from the genuinely asset-related spending. Do this early, and you will save yourself from some incredibly nasty tax surprises down the line.
And finally, Section 5, the mixed-use property myth.
Now, what's really interesting about mixed-use property, which includes both residential and non-residential elements, is that it gets taxed at significantly lower stamp duty land tax rates than purely residential property. And because of those lower rates, you better believe HMRC watches it like a hawk. Which brings us to the recent upper tribunal case of HMRC versus Christopher Brzezinski. Mr. Brzezinski bought a large house, but the property also happened to come with an island in a private fishing stream. He claimed the purchase was mixed use, so the million-dollar question, does a stream that naturally breeds trout magically transform a residential home into a mixed-use asset?
Spoiler alert, the upper tribunal gave a resounding no. While a lower tribunal actually initially agreed with Mr. Brzezinski, the upper tribunal stepped in, overturned it, and ruled the entire property was purely residential. The stream and the island, they were simply classified as the grounds of the house. Now, yes, the stream bred trout naturally, but the fatal flaw in the argument was that it wasn't being run on a commercial basis at the time the property was purchased. The lesson here is crystal clear. Just having an unusual feature or a separate parcel of land does not automatically grant you those lower mixed-use SDLT rates. The land must be genuinely non-residential or commercial in its ordinary use. It can't just be a really fancy part of your garden.
And that brings us to the end of today's explainer. From upgrading your software to meet those urgent making tax digital deadlines to separating out your early project costs, all the way to figuring out if your property or, even your marshmallows are classified correctly. 2026 is bringing massive shifts in compliance. So I'll leave you with this. Are your business records, your project costs, and your assets correctly classified for 2026? I highly encourage you to review your affairs right now. Update your digital systems, and please reach out for expert advice if you find yourself navigating these complex VAT rates, stamp duty claims, or CIS penalties. Thank you so much for joining me on this deep dive into the Tax ENews May 26 update, and I will catch you on the next explainer.